Okay, hello everyone. I am Richard Young. You are tuning in to a R&B Wealth Strategy Network presentation. Okay, this is for personal funding and income calculations. Okay, we've already covered personal funding, but this is going to be in addition to that, which is calculating a person's income. This is what the lenders actually do to be able to see if a person is capable and able to handle the finances that will be extended to them from a personal loan standpoint, not business. This is just for personal. So some of the information in the very beginning will be some things that you have already seen in our presentations, or you have seen in the reruns if you've actually watched them. But in addition, we are adding some links for you guys to be able to access not only on your own, but these are links that you can access that are lenders. It is something similar to what they use to see if a client will be able to receive a loan or not. Okay, this is going to be great. This is for the people that seem to run into people that have a decent credit score, but they don't have the income. They don't have what it takes to be able to receive a loan. This is with banks. This is with lenders. You can't get around this no matter what. And what it is we are providing you the information so you know for yourself. Okay? If people seem to think that they can go somewhere else and get around this, they're sadly mistaken. You might even just be wasting your time. This is only for you guys training. Okay? That is it. All right. Once again, we're going to run down some of the things that you already know, but we are going to go through it because this is a part of the full package product, okay? What we offer for unsecured personal loans. Over 100 lenders available to fund you or your client with an unsecured personal loan, okay? Minimum of 1 year in present employment and 560 plus credit score. The higher the credit score, the more favorable you are to getting approved. You have to have at least $25,000 annual income to qualify, period. No ifs, ands, buts about it. That is the lowest. Negatives such as bankruptcies, late pays, tax liens, they must be at least 2 to 3 years old. If they are not 2 to 3 years old, it will provide a very slim chance of them getting funded. And if they don't have these things on their credit, great. If they had them, but they had them deleted from credit repair, even better. At least 4 accounts on their file, revolving and installment accounts. These are some of the things that they need in order just to even be able to have credit, not only a credit score, but to show that they have had access to financing already before they even received this. All right. Once again, annual income of $25,000 plus, and we have loans from $1,000 up to $150,000. What your client needs, this is what your client needs no matter what. They have to complete the loan application. They have to have 3 months bank statements from their current account that has the most activity. All right, 3 current pay stubs and W-2 or 1099 if applicable. Not all lenders will request this, but if they happen to request this, then they have to have one of the two. All right. Now, just a quick to speak on this real quick. Some clients have been sending in W-2s, but then when they speak to the lender, they say that they only have 1099s, or they have a 1099, and then they switch it up when they speak to the lender and they say they have W-2s. Okay, this is something that we cannot get around. All right, if we can't help it. We can't help it. W-2s, they must have pay stubs, okay? But a 1099 comes with a commission, all right? Some of these clients, they need to understand that. Most of them, they will understand it because they are the ones that are living it. But that's what happens. W-2s, pay stubs. 1099s, commission. How lenders calculate who gets a loan based on income. Okay, this is the meat and the potatoes. This is what we are here for. This is what I wanted to be able to provide to you guys. Okay. Now, we all have wondered from time to time about if we would qualify for a loan or not. Use this calculator to see what the lenders and the banks would see to qualify you. This is a great link for you guys. I want you to copy it. We are going to put this presentation in the Facebook group so you guys can see it over and over again. It'll always be provided to you. Also, you can see at the bottom that I have it on my LinkedIn page. You can copy that link and you can have it readily available to you to use whenever, for personal use for you or your clients. I have already provided it in the Facebook group earlier today. Plus, I posted it the day before we even opened the group. So if you scroll down farther into the group, you will see that this is a link that has already been accessible to you guys. Okay, this is a loan calculator link, and it is a debt to income ratio calculator link. There's two of them. You can use them at any time. You can also find it on my LinkedIn page, no problem. If you don't already have my LinkedIn page, I suggest that you get it because I put additional information on there. Once I find information about the lending industry, such things as this calculator link, what type of outcome is coming from the lending space, so on and so forth. I post good information there. Facebook group, and into the WhatsApp at chat. Okay. What is my debt to income, all right, ratio used for? Lenders use your debt to income ratio to evaluate your current debt load and to see how much you can responsibly afford to borrow. Less debt equals more borrowing power. Higher debt equals less borrowing power. I don't know how simpler I can put it. I left it just like that because I don't want to get into information that really doesn't even pertain to what we're even talking about, because it is just that simple. All right. The less debt, the better chance they have of getting more money. The higher debt, the less borrowing power that they actually have. It is that simple, ladies and gentlemen. And once again, you can view this later on and you can utilize this for your own information. Okay, debt to income, good scenario. This is typically what the numbers would actually boil down to. Okay, once you use that debt income calculator, watch this presentation, log on to the link, put in the same numbers and see the exact same thing that we're seeing. Okay, now let's say that one of your clients has a $50,000 income, all right, and they're paying, let's say, $700 in rent. They have $100 in credit payments, and they have a $400 car loan, which would amount to $1,200,000 debt each month. Okay, simple. Let's find out if they qualify or not. What their debt to income ratio would be according to the lender's calculator, they would fall under a 17 to 24 percentile of what their income is, or what they're utilizing within that income. What they want to see is that you have somewhere between 25 and 25% of what they're currently using. 25% of what you're using for the home, and 25% of what you're using for things outside of the home. Okay, and you will learn all of this stuff. It is very simple, and I will break it down for you. Okay. Now, basically, what a person will ask, what is my debt to income ratio? All right. Your debt to income ratio consists of two separate percentages: a front ratio, housing debt, which we discussed, and a back ratio, all debts combined, which is things outside of the home. All right. This is written as front to back. This is lender lingo or mortgage broker lingo. Okay. This is some of the things that you'll hear if you actually deal with them. Some of you guys that are looking to deal with closing on a house soon or in the future or getting a loan, this is the information that you need to know, not only for yourself but also for your clients. It will make you greater in this space that we are dealing with. All right. Now, with the current numbers that we have up top, all right, your front ratio is 17%. Okay, this means you pay in-house costs out of your income each month. That is what the front number is. Your back ratio is 24%. This means you pay in-house and other debts out of your income each month. Okay, remember what we said before, that your debt to income ratio needs to be 25% and 25%. 25% front ratio and 25% back ratio. So that means that your front ratio 17%, you're in good standing. You're under the 25%. Your back ratio 24%, you're in good standing. You're under the 25%. Okay? Now, what does my DTI, debt to income ratio, mean? Your DTI ratio is in good standing for these numbers, 17% and 24%, based on the numbers that are provided up top. This person is in very good standing. They will no doubt be able to get a loan based upon just the income. All right. Now, that's not to talk about their credit score. If their credit score doesn't meet the standards that we provided, that you already know that their credit score has to already meet at a 560, negatives that has to be 2 to 3 years old. They have to have 3 bank statements, 3 check stubs, so on and so forth. Other than that, this is a great scenario for a person to be able to receive lending. So if you combine this with their credit requirements, and if their credit requirements are good, this is a person that is a great candidate. This is how we look at people. This is how the lenders look at people, and this is how we pre-qualify people before we even take them to the lenders. This is how, when we do a client that we get, we already pre-approve them no matter what before they even get to the lenders. So we already know this person is definitely going to get funded. We put them in through the application process and they receive the financing that they're actually looking for, because this is one of the stipulations that we actually use. Okay. Now, also remember that the banks require for a person to have at least a 680 credit score. All right, we are requiring that a person has to have a 560. That is a very big difference. So if you take a bank that needs a 680 credit score plus this debt to income ratio in good standing, it's harder to get a loan. All right, now with us, it's a 560 plus this debt to income ratio. That's why we are able to get more people funded. Okay, the banks, their stipulations are a lot higher. A person needs to have at least 100 points more plus their debt to income ratio to be good in order to qualify. With us, it's the debt to income ratio to qualify with a lesser score. That's why we get more approvals. That's why the people that I work with even more closely, once I know their credit score and I check out their debt to income ratio, a lot more will qualify for our program than the actual banks. If they qualified for the banks, 9 times out of 10, they wouldn't even talk to us. And that's only a small percentage. Okay. Now, the last line is basically what I laid out to you guys of a 25 and 25. All right. What are some common debt to income requirements? Mortgage lenders use DTI to ensure you're not being overextended with your new loan. Experts recommend having a debt to income ratio of what? 25%, and 25%. 25 on the front end, 25 on the back or below. The reason why we have mortgage lenders on here is because when we use our debt to income ratio calculators, the same that the lenders use, if they qualify for a mortgage lender, then they will definitely qualify for a loan. All right, we use a little tougher stipulations so we can ensure that the people that we are dealing with will definitely qualify for a loan. Okay, so don't get thrown off by the mortgage lender down there. This is specifically really for only our space to calculate if a person will be good for a personal loan. And once again, if they qualify for a mortgage lender, they will qualify for what we have. Now, let's take a look at a bad debt to income ratio scenario. So let's say that a person makes $50,000 a month in income, $13,000 a month is used for rent, $600 is on a car loan, $200 is used for credit card debt, and let's just throw in $100 for other, maybe electric bill or going out restaurants or whatever you may have. Okay, now their debt to income ratio is 31/53. So basically that's 31% on the front end and 53% on the back end. Now remember our original numbers that they have to be somewhere in between 25% and 25%, which is 25% on the front end and 25% on the back end. Now what we have is a person that is over 31% on the front and over 25% on the front end, and they're over the 25% on the back end. All right, so they're at 31% and 53%. All right, now on the front end, they got 31%, which means this is their in-house cost of income per month. On the back end is 53%. This means you have in-house costs and other debts outside of the house. Okay, now what does this mean? Your debt to income ratio is high. You will get this with the lenders. You will get this with us. Okay, typically what they will be thinking is you should consider ways to reduce your spending on housing and other debts in comparison with your income. They're not going to tell you this. We are. Because we want you to be successful. We want you to be able to find successful clients, and we want our clients to be able to get funded. So we'll tell them these things up front before we even put their application through. We'll let them know if they're going to qualify or not. Okay, but we want you guys to be equipped with this information, because the last thing that we can do is not only do the applications that we're doing, but to do all the applications of the people that we have as agents and do debt comparisons with every single person that comes through. We'll never get off the phone. We'll never be able to do an application, and we'll never be able to get a person funded, because we're always dealing with a person's situation to see if they qualify or not. Okay, so we need you guys to be proactive, and this is even a part of when you guys are able to get your links later on to where you can do your own underwriting and submit your own applications. Before you can even do that, we have to prepare you to be able to do it. Okay, that's one of the reasons we need to give you guys these links in the very near future, so you can do your own underwriting, because a lot of you guys are taking off very fast. You are running very hard already out of the gate. Now just imagine if all the people we have, plus the new agents that we know that we have coming on board later on in the future, are running very, very hard, and nobody is able to do their own underwriting. Okay, well, we would be in the office all day, every day, and we wouldn't be able to provide any training because we'll be too busy analyzing your clients, trying to get them funded, and then dishing out checks to people. So we need you guys to be able to know how to do your own underwriting, and this is definitely what's going to help you to be able to do it, especially in the personal lending space. Okay, so this is a bad debt income ratio scenario. All right, both the front and the back end is over 25%. That's not going to get funded. It really doesn't matter what their credit score is, because what they're saying to the lender is that they are stretched beyond what they could ever lend to them. There's no way that they would be able to pay them back because they're too busy paying on the bills that they already have. Okay? Now, before we even get to any questions about that, I want to reiterate on some of the things that your clients will get denied for. Okay? Now, if they just recently applied for credit and they were denied, and 9 times out of 10, it isn't just one time, they did some credit cards and some loans and so on and so forth, and they've racked up all these denials, and then they want to come to us. This is a reason why they would get denied. If they don't have at least $25,000 in income or one of the other requirements we already spoke of, they will get denied. If they have too many inquiries, okay, and for each lender it's different, so there's no sense in even really inquiring on how many inquiries a person has to have in order for them to get denied. Some lenders, if you have 5 or 6, denied. Some lenders, they'll go up to even 10 or 12. If you go over that, you're denied. So if they have too many inquiries already, which means that they've already tried to receive financing somewhere else, you're denied. If their credit is maxed out or over the utilization amount the lenders are comfortable with, that means you will be denied. Okay? And when it comes to that being maxed out in your credit, it could be somewhere anywhere between 30% and 50%. Who knows? Some of our lenders are more flexible, but that will put them into the smallest percentile of the lenders that will actually lend to them. So typically, when it comes to credit, anytime a person is over 30%, you are running into the red. You are running into the type of person that is not going to be lendable because you're just using too much of your credit. That's how the personal consumer space goes. That's how the personal credit space goes. I'm sorry I didn't make the rules, but if a person is over 30%, then that means that you are already using too much of your credit. All right. If their documents do not match what they put on the application, they will be denied. If you put down that you work for a company and you have check stubs and a W-2, but then you say that you have a 1099 and you work off a commission, red flag automatically. Your information, what you're saying on the phone, doesn't match up with what you're putting on the application. I'm sorry, but that's just how it goes. You have to be consistent. These people need to know what they're receiving from the places that they work for. If they don't know what they're getting, then I don't know what to tell them. If you work for a company, you know you are going to get a paycheck stub, and at the end of the year, you're going to get a W-2. If you know that you're just an affiliate for a company or whatever, and you get commission, then you know that you get a 1099. You know these things. If they don't know them, then I don't know what to tell them. I'm not in their personal lives, okay? But if the person's documents do not match with what they put on the applications, they will be denied. If they have any of the negatives that we stated, they cannot have under the 2 to 3 year mark, they will be denied. Tax liens, late pays, bankruptcy, so on and so forth. If they are less than 2 to 3 years old, they'll be denied. All right, this is information that is great for you guys. This is for the denial part. We've already covered the debt to income ratio, and you guys can utilize this information at any time. Now, I want to be able to open up the questions to you guys. Okay, give me 1 second so we can really see what is on you guys' minds. You will be able to you guys will be able to 1 second.